Section 1. Kenyan Stock Market. Overview June 4, 2024. A snapshot. The Nairobi Securities Exchange witnessed a positive trading session on June 4, mirroring a global trend of market optimism. The benchmark NSE 20 Share Index, a key indicator of market performance, closed the day higher, reflecting renewed investor confidence in the Kenyan economy. Trading volumes were robust, indicating active participation from both local and foreign institutional investors. Market sentiment was largely driven by positive economic indicators and favorable global market conditions, contributing to the upward trajectory of the Kenyan stock market. Several factors contributed to the positive performance of the NSE on June 4th. Firstly, the release of encouraging economic data, including a growing manufacturing sector and increased consumer spending, boosted investor confidence. Secondly, favorable global market conditions, with major international indices also showing gains, had a positive spillover effect on the Kenyan market. Lastly, increased liquidity in the market, fueled by both local and foreign institutional investors, provided further impetus to the upward trend. The positive performance of the NSE on June 4th reflects the resilience and growth potential of the Kenyan economy. Despite global economic uncertainties, Kenya's stock market has shown remarkable resilience, attracting investors seeking growth opportunities. The strong performance across various sectors, including financials, industrials, and consumer goods, underlines the diversified nature of the Kenyan economy and its potential for sustained growth in the coming months. The upward trend observed on June 4th is expected to continue in the near term, driven by positive economic fundamentals and investor confidence. However, investors are advised to remain cautious and monitor global market trends, as volatility remains a possibility in the ever-changing global economic landscape. The Kenyan stock market remains an attractive investment destination, offering investors the potential for significant returns in the long run. Section 2. Financial sector takes center stage. Banks outshine. The financial sector emerged as one of the top performers on the NSE on June 4th, driven by strong gains in banking stocks. Leading banks, including Equity Group Holdings and KCB Group, witnessed significant price appreciation, reflecting their strong financial performance and positive investor sentiment. The banking sector's positive performance can be attributed to several factors, including a growing loan book, improved asset quality, and increased profitability. Equity Group Holdings, one of the largest banks in Kenya, saw its share price surge, driven by impressive financial results and a positive outlook for the future. The bank's strong performance can be attributed to its focus on digital banking, regional expansion, and a diversified loan portfolio. KCB Group, another major player in the Kenyan banking sector, also witnessed significant gains, reflecting its robust financial performance and strategic initiatives. The strong performance of the banking sector is a testament to the resilience of the Kenyan financial system and its ability to withstand economic headwinds. Banks have benefited from increased lending to businesses and individuals, driven by economic growth and improved access to credit. Moreover, improved asset quality, resulting from a decline in non-performing loans, has further boosted the financial performance of banks. The positive outlook for the Kenyan economy, coupled with favorable regulatory policies, is expected to support the continued growth of the banking sector. Increased investment in technology and innovation, along with a focus on financial inclusion, are expected to drive further growth in the sector. Investors are closely watching the performance of the banking sector, as it remains a key indicator of the overall health of the Kenyan economy. Section 3. Industrials power ahead. Manufacturing shows promise. The industrial sector also witnessed robust growth on June 4th, driven by strong performance in manufacturing stocks. Companies involved in cement production, construction materials, and consumer goods manufacturing recorded significant gains. This positive trend reflects the growth of the Kenyan manufacturing sector, supported by government initiatives to promote industrialization and attract foreign investment. Leading cement manufacturers, such as Bamburi Cement and East African Portland Cement, saw their share prices rise, driven by increased demand for construction materials. The growth in the construction sector, fueled by infrastructure projects and real estate development, has driven demand for cement and other building materials. Companies involved in the production of consumer goods, such as Unilever Kenya and British American Tobacco Kenya, also witnessed gains, reflecting strong consumer demand and increased spending power. The Kenyan government has identified manufacturing as a key driver of economic growth and has implemented policies to promote the sector, including tax incentives, infrastructure development, and skills training. These initiatives have attracted both local and foreign investment in the manufacturing sector, leading to increased production and job creation. The growth of the industrial sector is also being driven by increased demand from neighboring countries, as Kenya positions itself as a regional manufacturing hub. The positive performance of the industrial sector is expected to continue in the coming months, supported by government policies, increased investment, and growing regional demand. The sector's growth will play a crucial role in driving economic growth, creating jobs, and reducing poverty in Kenya. Investors are closely monitoring the performance of the industrial sector, as it offers significant growth potential in the long term. Section 4. Energy sector, mixed bag renewables shine, fossil fuels falter. On June 4th, the energy sector presented a mixed picture, with renewable energy companies outperforming their fossil fuel counterparts. Companies involved in geothermal and wind energy generation witnessed significant gains, driven by the government's commitment to renewable energy and growing investor interest in sustainable investments. In contrast, fossil fuel companies faced headwinds due to volatility in global oil prices and concerns about their environmental impact. KenGen, the largest power producer in East Africa, which generates a significant portion of its electricity from geothermal sources, saw its share price rise, reflecting investor confidence in the company's strong fundamentals and growth prospects. Other renewable energy companies, such as wind power producer KenWind, also benefited from the growing investor appetite for sustainable investments. On the other hand, fossil fuel companies, such as oil marketer Total Energies Marketing Kenya, faced pressure due to fluctuations in global oil prices and concerns about the long-term viability of fossil fuels. The Kenyan government has set ambitious targets for renewable energy generation, aiming to achieve 100% renewable energy by 2030. This commitment to clean energy has attracted significant investment in the sector, leading to the development of large-scale geothermal, wind, and solar power projects. Investors are increasingly recognizing the growth potential of renewable energy in Kenya and are shifting their focus towards companies operating in this sector. The energy sector in Kenya is undergoing a significant transformation, with renewable energy playing an increasingly important role. The government's commitment to clean energy, coupled with growing investor interest, is expected to drive the growth of the renewable energy sector in the coming years. Fossil fuel companies, on the other hand, face an uncertain future as the world transitions towards a low-carbon economy. Section 5. Consumer goods remain resilient. Staple products drive growth. The consumer goods sector demonstrated resilience on June 4th, driven by steady demand for essential products. Companies involved in the production and distribution of food, beverages, and personal care products witnessed stable performance. This reflects the essential nature of these products and their relatively low price elasticity of demand, even in the face of economic uncertainties. Leading consumer goods companies such as Unilever Kenya, East African Breweries Limited, and British American Tobacco Kenya maintained their market positions. Unilever Kenya, which produces a wide range of consumer goods including food, personal care products, and home care products, benefited from its strong brand recognition and extensive distribution network. East African Breweries Limited, the largest brewer in East Africa, witnessed stable demand for its products, driven by a strong brand portfolio and a loyal customer base. The consumer goods sector in Kenya is expected to benefit from several factors in the coming years. Population growth, urbanization, and rising disposable incomes are expected to drive consumer spending. Moreover, the growing middle class, with its increasing purchasing power, is expected to create a larger market for consumer goods. Companies operating in this sector are focusing on product innovation, brand building, and expanding their distribution networks to capitalize on these growth opportunities. The consumer goods sector is a key driver of the Kenyan economy, accounting for a significant portion of the country's GDP and employment. The sector's resilience, even in the face of economic challenges, highlights its importance to the Kenyan economy. Investors are likely to continue to view the consumer goods sector as a relatively safe and stable investment option, especially during times of economic uncertainty. Section 6. Looking ahead. Opportunities and challenges in the Kenyan stock market. The Kenyan stock market's performance on June 4, 2024, reflects the country's economic resilience and potential for growth. The strong performance across various sectors, including financials, industrials, and consumer goods, highlights the diversified nature of the Kenyan economy and its ability to attract investors seeking growth opportunities. However, it is crucial to acknowledge both the opportunities and challenges that lie ahead for the NSE. One significant opportunity lies in the increasing integration of the Kenyan economy with the East African region. As a member of the East African Community, EAC, Kenya benefits from a larger market and increased trade flows. This regional integration presents opportunities for Kenyan companies to expand their operations, access new markets, and drive economic growth. Investors are increasingly recognizing the potential of the EAC and are seeking investment opportunities in the region, which could further boost the Kenyan stock market. Another opportunity lies in the government's commitment to infrastructure development. Kenya has made significant investments in roads, railways, and energy infrastructure in recent years, which are expected to support economic growth and attract foreign investment. These infrastructure projects create opportunities for companies operating in the construction, materials, and energy sectors, potentially boosting their stock market performance. Moreover, improved infrastructure is expected to reduce transportation costs, enhance connectivity, and facilitate trade, further benefiting the overall economy. However, the Kenyan stock market also faces challenges that could impact its future performance. One key challenge is the volatility of the global economy. Global economic uncertainties, such as geopolitical tensions, inflation, and rising interest rates, can impact investor sentiment and lead to capital flight from emerging markets, including Kenya. The NSE is not immune to these global headwinds, and investors should be prepared for potential volatility in the market. Another challenge is the relatively low level of liquidity in the Kenyan stock market compared to more developed markets. Low liquidity can result in wider bid-ask spreads, making it more expensive for investors to buy and sell shares. This can deter some investors and limit the growth potential of the market. Addressing liquidity challenges, such as through encouraging more retail investor participation and attracting institutional investors, is crucial for the long-term development of the NSE.